Here is where your next question should land like a weight. If they could do this, why did they not simply destroy themselves? Because the last safety net in the system is not risk management, it is central banking. In 2020, when the market was stressed, the Federal Reserve stepped in to stabilize funding conditions.
It created extraordinary liquidity through multiple channels. It ensured that the short-term plumbing did not remain broken long enough to make insolvency contagious across everything. That matters, because when investors believe that central banks will step in, the natural human reaction is not to stop taking risk. It is the opposite. It becomes permission. In simple terms, the tragedy is not only that there was a crisis.
It is that the crisis taught leveraged players a lesson. When you fail loudly enough, the system will rearrange itself to save you from the full consequences. So they failed again, just with bigger leverage and better timing. Now jump to 2022 through 2024. You watched the Federal Reserve change its posture. You watched rates rise and balance sheet policies shift. You watched inflation behave like an illness that is never fully cured, only managed.
And while real households were dealing with higher borrowing costs and stubborn price increases, the biggest players adapted their behavior. They borrowed at the times when the system allowed it. They parked capital at the times when risk looked unacceptable. And when it was profitable again, they returned to the same basis machine. This is how risk is preserved inside a loop. And now we need to talk about the part that connects this to 2026 life directly: wealth concentration.
In 2020, many people saw a market chart and assumed it meant prosperity. But a market chart is not a payroll chart. It is not a rent chart. It is not a grocery receipt chart. While the stock market recovered, wealth concentrated. Top households benefited from asset prices rising and from the ability to borrow against assets. Middle and lower income households benefited from nothing except higher prices. In 2026, you are living in the consequences. You may have an AI-related job anxiety.
You may have a housing cost that never returned to what it was. You may be watching real interest rates and wondering why they do not feel like freedom. Meanwhile, the system keeps running like a private club, and there is an additional layer of distortion you cannot ignore: global debt. Global debt is over $300 trillion. That is not a metaphor, that is a literal pile of obligations that must be serviced and rolled over. When debt piles up, liquidity becomes the bloodstream.
And when liquidity is the bloodstream, central banks become the heart. They can keep it beating. But the price is paid elsewhere, in delayed damage, in inflation, in the real economy, and in political pressure that gets translated into financial engineering. Now think about AI in 2026. AI did not only replace tasks, it replaced bargaining power. It reduced the value of routine work faster than communities could retrain. The result is the same as the financial mechanism.
When value becomes scarce for you, you become more dependent on whatever system can provide stability. But stability often means protecting the core operators, not you. Housing is the clearest example. In the United States, the United Kingdom, Canada, and Australia, housing detached from wages. That means many people do not just face affordability stress. They face a lifetime of renting unless they already own an asset. Renting is the financial equivalent of paying interest without principal.
Every month is cash out the door, while ownership compounds for those who already have it. And inflation makes that worse, because inflation is a tax you do not vote on. Even when inflation looks better on paper, your lived purchasing power often lags for years. Your salary climbs slower than your expenses, and you lose the margin that used to cushion emergencies. So the question becomes not will the next crisis happen, because it will.
The question becomes who gets protected first and who gets blamed last. Now here is where things get truly ugly, and I want you to hold on to this. In 2020, the system contained the fire fast enough to prevent a total cascade. But containing the fire does not mean eliminating the fuel. It means the fuel moves. In the years after, many financial players continued to assume emergency support would come again if things got too hot.
So they maintained large positions and increased capacity for profit when spreads moved. But what happens when the system tightens again? When liquidity becomes expensive, when balance sheets shrink, and when central bank policy shifts without an immediate replacement mechanism. The unwind comes faster. In other words, the next crisis does not need a pandemic to start. It can start from the same plumbing weakness: leverage, funding dependence, collateral requirements, and forced selling.
And if you want a 2026 clue, look at what is happening outside stocks. Insurance markets are collapsing in some regions. Climate-driven disruptions are increasing migration costs. That means real-world balance sheets are stressed, not just financial ones. When real-world cash flows are stressed, households miss payments, businesses default, banks tighten credit, funding markets get nervous, and then the same liquidity logic returns. Now connect that to retirement. Pensions are underfunded.
Social Security is delayed by politics and aging populations. People keep getting told to work longer, like time itself is a commodity they can purchase. But if you are working longer, you are also exposed longer. And if inflation stays sticky in the real economy, your retirement account contributions lose value every month until you can retire only by sacrificing dignity or health. This is not an accident.
It is what happens when the financial system is optimized for rolling obligations, not for improving lives. Now let's bring crypto into the conversation, because in earlier cycles it was sold as freedom from banks. In 2026, crypto is more regulated and more institutional than the original fantasy promised. Banks and large firms hold more of the ecosystem than individual retail investors. That does not make crypto useless, but it does change the power structure.
When liquidity tightens in traditional markets, the same pressures often flow into the crypto market through funding costs and hedging behavior. So the supposed escape route becomes another channel of volatility. Same machine, different jacket. Now the last cliffhanger for this script is the part you should not ignore. Many people think the 2020 crash ended the story. They think once central banks printed and bought risk, the danger was over. But the danger was not eliminated.
It was redistributed and then rewarded. Leverage that almost broke the system was not punished in proportion to the damage it caused. It was repaired. Profits continued. The next time the basis trade or the funding strategy worked, insiders scaled again. That means the system learned the wrong lesson. Not that risk is dangerous. That risk is profitable when the downside is socialized. And that is why you keep seeing a strange contradiction in 2026.
Markets may surge while individuals feel cornered. That disconnect is not purely emotion, it is structure. The stock market reflects expectations for capital providers. Your life reflects expenses, wages, rent, debt payments, and delayed retirement. Two different realities, running side by side. So what can you do with this knowledge without turning into a paranoid mess? First, accept the truth. Crises are not only about bad news.
They are about cash, collateral, and who has access to liquidity when everyone else is panicking. Second, accept the truth. Printed money does not just disappear into the clouds. It changes behavior. It changes who takes risk. It changes what institutions expect the rules to be next time. Third, act like the rules are not fixed. They are adaptive. They move in favor of the party that already has the balance sheet strength.
If you have been holding cash and waiting for a safe, calm decade, you should understand something brutal. Cash can survive. But cash can also lose to inflation, especially when your cost of living keeps rising faster than your yields. If you have been assuming that a diversified portfolio automatically protects you from systemic shocks, understand this too. Diversification can reduce idiosyncratic risk. It cannot stop liquidity-driven sell-offs when forced selling hits everything.
And if you have been believing the dream of passive income through social media, recognize the pattern. Most people chasing that dream are not generating wealth. They are generating content. The creator economy sells you the fantasy, while many creators report zero or near zero income. Meanwhile, the wealthiest participants keep access to capital, tax advantages, and borrowing power. This is how the system transfers outcomes upward. So yes, the next crisis will come.
Not because of bad luck, because leverage cycles and policy responses build repeating stresses. The window is not 10 years, it is right now. In 2026, With AI reshaping employment and housing remaining structurally unaffordable, households are more fragile, not less. If the plumbing freezes again, it will hit people like David harder than it hits the institutions that engineered the plumbing. You are not helpless, but you are not special either.
You must plan for a world where emergency support exists for the powerful and delay exists for everyone else. Send this to someone who still thinks the system is going to take care of them. They need to hear this before the next crash. If this changed how you see money, subscribe. I put out one of these every week, and most of what I cover you will not hear anywhere else until it is too late.